Okay, I guess it would be good if we could make a start. So we have Shane Rosenthal, Regional Director of Pacific Liaison and Coordination Office, joining us today. And this is first of the ADB sponsored webinar on correspondent banking and correspondent banking requirements. And this invitation sent out to counterparts and colleagues from the Pacific. Please feel free to extend the invitation to colleagues outside Pacific as well. There's just a small requirement for participants to register on the call. And we have with us Shane Rosenthal, the Regional Director of the Pacific Liaison and Coordination Office, Sydney. And as the Regional Director of the PLCO office, Shane oversees the implementation of operations in Nauru, Solomon Islands, and Vanuatu. In addition to its programming, Shane basically is the bank's hub. The office is the bank's hub for development of private and finance sectors for 14 Pacific developing member countries. The location of the office in Sydney enables ADB to work closely with our key bilateral partners, including Australia, New Zealand, the World Bank Group, and other multilateral institutions in the region. As a national of Australia, Shane has qualifications in economics and arts from various universities across the world, and he's got 30 years of experience in development. I invite Shane to deliver his opening remarks for today's workshop. Thank you, Shane.
Thank you very much, Shu. Apologies, there we go. I managed to turn on my camera. Good morning, everyone, and welcome to the first of a series of webinars that the Asian Development Bank is hosting on correspondent banking. I think recently we have all seen a growing focus on regulatory measures against financial crime across the world. And this year, we're going to see even greater regulatory scrutiny on financial crime globally, with implications for the financial landscape. Across the globe, financial institutions are tightening their controls to combat money laundering and financial crimes. Our reliance on correspondent banking for international trade means that the stakes are indeed high. Unfortunately, due to the perceived lower compliance capacity and limited access to verification databases in financial institutions in our region, many international banks have chosen to mitigate their exposure to potential risks by discontinuing business relationships with us, motivated by the fear of significant fines for relatively small transactions. The consequence of this de-risking strategy is, of course, higher costs for personal and business transactions. And this impacts the services provided by respondent banks and affecting our economies, not least by hindering economic activities across our region. In response to these challenges, ADB aims to enhance the capacity and effectiveness of compliance frameworks in banks in our region, which are critical not only for maintaining access to international payment systems, but also for facilitating regional cooperation and integration in the banking sector. And amidst the pressing concerns surrounding financial crime and its implications, it's really imperative that we join forces together to strengthen our due diligence and controls. So today, I'm excited to introduce one of our regional initiatives aimed at building the capacity and effectiveness of our compliance frameworks. We'll embark on a series of comprehensive training sessions aimed at equipping financial institutions with the knowledge and to combat financial crime effectively. We're beginning this morning with this introduction to correspondent banking. A correspondent banking relationship, as many of you know, involves one financial institution, the correspondent, providing banking services to another financial institution, the respondent, where both institutions are in different countries. Correspondent banks provide the respondent bank with international wire transfers, check clearing, and foreign exchange services. Today's introductory module is going to focus on 6 critical components of correspondent banking And in the modules that come in future, we're going to dig more into each of these. We'll start with customer due diligence process. Understanding our clients is paramount. This training will delve into the crucial aspects of risk-based approach, customer risk assessment, and the due diligence process for ensuring a thorough and comprehensive understanding of those we engage with. Number 2 will be sanctions and terrorist financing. Recognizing and preventing illicit financial activities is essential. We'll explore the nuances of sanctions and the financing of terrorism to fortify our defenses against these threats. Third is enterprise-wide risk assessment. A holistic approach to risk is essential. This session will guide us in conducting enterprise-wide risk assessments, identifying potential vulnerabilities, and implementing strategies to mitigate risks effectively. Number 4 is transaction monitoring. The heart of our fight against financial crime lies in vigilant transaction monitoring. This training is going to provide insights into establishing robust systems to monitor and flag suspicious transactions promptly. 5th is anti-bribery and corruption. Upholding the highest ethical standards is non-negotiable. This session will address strategies and policies to combat bribery and corruption within our financial institutions. And finally, number 6 is suspicious transaction investigation and reporting. Timely and accurate reporting is key to our success. This training will focus on the investigation and reporting processes, ensuring a seamless and efficient response to suspicious transactions. I look forward to your active participation as we embark on this journey together. Knowledge is power, and armed with the knowledge gained from today's webinar, our collective efforts will contribute to the financial integrity of our region. Good luck, everyone, and thank you, Shu. Back to you.
Thank you very much, Shane, for those opening remarks. From my end, it's welcome to everyone to this webinar. This is ADB's support for the banking sector in Pacific, in particular, for the correspondent banking challenges that each country and each institution is facing. Some of the institutions are able to maintain relationships, others find more challenges. And for us, we have different aspects of support, and this is capacity building directly for the private sector and regulators. So for us, we have Julia Chin joining us as an expert in the industry. She is a very seasoned professional in the financial industry with over 25 years of experience. Expertise developed in policy with focus on client due diligence, operational risk management, and proficiency in correspondent banking, securities services, in fintech, financial crime, regulatory compliance, and the list goes on. So throughout her career, Julia has contributed to consultancy, global banking, regulatory entities, such as working with esteemed institutions such as Standard Chartered, HSBC, Deutsche Bank, Clough, and KPMG. With this diverse background, I'm very sure that her experience in implementing and designing and the control frameworks to meet higher standards would be of use to all of us. Julia is very passionate about compliance and very enthusiastic about the intersection of fintech and financial inclusion. So we hope to learn a lot from her, and I'm very keen to stay on the call throughout the series myself. Julia is a registered volunteer with Bankers Without Borders, and she is also part of the Macron Club. So with those significant notable achievements, Julia, I hand this over to you. Thank you.
Thank you so much, ADB, for inviting me to conduct this webinar today. I'm really honored, and thank you so much again. Okay, without further ado, let me just share my screen. We'll start. Can you see me? Can you see the screen? Yes. Okay.
Yes.
Great. So right. we will start today, as Shane has mentioned, we will start the webinar series with an introduction to correspondent banking. And this is me. My trainer profile is that I am Julia. As Shu mentioned, I have this experience in correspondent banking in particular, and I'm a member of the Asia Pacific Global Coalition to Fight Financial Crime Secretariat, and also a member of a global digital finance AML working group. So this is on the virtual as a service provider. And okay, so at the moment, I also am the secretary for the fraud and scam working group for the GCFFC, which I think over the next few weeks you will get to probably hear a little bit more about what we do there. And right. So administration, first, I guess your microphones are muted when you're not speaking. Please have your mobile phone handy because we will be using that as well. But I'll also put the link in if you need to. And then use the group chat if you wish to make a comment or ask questions. What I noticed is that, yeah, because all our participants are muted, so please put your hand up when you need to ask a question or use the group chat. And then some of you would have received a survey by SurveyMonkey. Please complete the survey by the 15th of March, because what I intend to do is that the content is still currently in the process of being built up, and when you do the survey, it gives me an idea on what you're looking for and what kind of information that you would want to do, you want to hear, so that way I can build that into the content as far as possible. And then there is a parking lot, which I will also introduce. We will be co-creating the content. So what I think that it would be good is, that's why I would like to also get more questions from you so that we can build that together. Participate actively, have fun, and there will be a participation certificate that will be given to all the participants after the series. And if you complete 75% of the entire course. So right, here is the first parking lot. You see the Slido, and you can use the QR code to scan, as I mentioned, or hang on. Oh, sorry. Are you able to scan the QR code, or do you need me to post it in the group chat?
Able to access the module using the QR code, but would be good to post it on the group chat in case someone joins later and is still able to access that, Julia.
Oh, okay. Yeah. If anyone were to access later, I'll post it again. Just hang on. Yep. So this is where you would be able to ask questions. Right. Let's continue. Right. So the first module, as I mentioned, is actually the correspondent banking introduction. And then after that, the second module, which is going to be on the 19th of March, we will go into the fundamentals of customer due diligence. So these are actually the 6 components that are very important for us in fighting financial crime. And then after that, we'll continue with the next of the modules. So learning objective of this current module is that we will look into the fundamentals of correspondent banking. We'll talk a little bit about the FATF and the Wolfsburg. The Wolfsburg is the group that actually drives most of the correspondent banking due diligence and the best practices. Then also next, we will also talk about the AML and the counter-terrorist financing programming, the program, and then also our concerns as we know it on the concerns on the de-risking that we have in this region. And then we will touch about the future of correspondent banking, the evolution and the innovation as we see it happening right now. Okay, so this is the other one that we have, which is on, I know that we have actually done a poll. The survey actually had a question about how familiar you are with correspondent banking, but I thought that it would be good, useful for us to also understand from the audience here, for those of you who may not have completed the survey, how familiar you are with correspondent banking. Let me just, once you've shared. Let me stop the share screen. I'm going to try to open the Slido and see if anyone is able to join. Is everyone able to join?
We'll also note that some of our colleagues may be joining from conference rooms as well. And
Oh,
we have
okay,
just
okay,
one
okay.
registration, but there'll be a few people that would be participating.
Okay. Right.
Thank you.
Thanks for letting me know. I am sorry about the I think the parking lot has expired. I need to give you a new one. Let me see.
With the scores, Julia, we have about 57% rated themselves at 1, and I'm one of them, to be honest. But we have about 29% of the participants at 29% and 14 at 4. So you sit at the high end, and we all look forward to learning from you.
Okay, thank you so much, Xu. Okay, let me also share the screen to show you what Xu mentioned. Obviously, I'm still struggling to okay. Right, this is what we have. Great. then at least I know where to go in terms of the pace of this particular session. Thank you so much. Thanks so much, Shiu, for helping me with the slide.
No problem.
And okay, so the parking lot, just to let you know, because the parking lot actually the link has expired. I have provided a new link. Oh, sorry. I have provided a new link to the parking lot. I think this should be the new parking lot. Right, let's continue. Okay, so I thought I'll start the to set the scene by talking about the fraud and scam worldwide. I did notice that a lot of the people during the survey has mentioned that the biggest concern in the region is actually about fraud and scam. I think it is generally across the entire world, it's globally. And also what happened was that, which is exactly why the working group for the Asia Pacific GCFFC fraud and scam working group has been set up, and is actually to look at how we can build a framework and build more awareness in this area. So if you look at it, Asia Pacific is a really, really peculiar, or rather we are in a very difficult situation where we have a very diverse group. And so because of that, we actually have a lot of people who sit in both ends of the spectrum, where there are people who are victims of human trafficking, who are kidnapped into doing the scam, being forced into scamming. These are the job scams portfolio. And then there are the richer, those that have more funds available to them, being victims of investment scam, or what in the Western countries they are called pig butchering. I'm not sure whether you have heard of it, but that's what this is being called pig butchering, which is where they groom those victims, and then after that they just take all the money from the investments. So right now what we are seeing is a lot may have also read about all these scam compounds. There are the scammers who have gone pro, they are also into marketing, they are operating globally, they are using artificial intelligence, and they are even setting up scams as a service platform. A lot would have heard about banking as a service platform, software as a service. Now we have even scam as a service. So it is getting quite scary, I would say. That's why we are here today, to try and solve the problem together, and we cannot do it alone. Okay, so Singapore, August 2023. Hang on. Sorry, I'm at home, and so there's a lot of people moving about. Okay, Singapore, August 2023. It was a collective action by the Singapore police force, in that they arrested 10 people who are foreigners in this country, in Singapore, where we are still counting at the moment. It's 3 billion Sing dollars worth of assets that have actually been confiscated so far. And there's actually even more. Investigation is still happening, so I wouldn't be able to share too much, nor do I know enough. So this is what we know. 10 people have been arrested and their assets confiscated. And then there were a lot of people who have been identified. And these are currently also, some of them are being called in for questioning. Some of them are not in the country, and still being searched around the world. Actually, we don't know where they are. So generally, that's what it is. And we will talk a little bit about this particular incident, or exciting thing that happened in Singapore over the next course of the series as well. Okay, so when we talk about money laundering is that we don't really see what is happening at the back end, but and why we are doing it. But also to remember that these are all dirty money, and it is not a victimless crime. And money laundering is basically a crime out of a crime. And we talk about, my mom was also nearly scammed as well. She always gets a lot of all these she always gets a lot of people trying to contact her on Facebook and to make friends with her. And then we talk about human trafficking. We talk about online sexual exploitation of children. We talk about wildlife trafficking, and we see the corner bottom picture is actually from the earthquake in Turkey, where bribery and corruption had actually caused a major effect on, because of the corruption, the buildings would not have collapsed if not because of the poor quality of the construction. And the middle top one is where these are the job scam victims who were kidnapped and put into scam compound, being tortured if they do not meet their key performance index of scamming enough of money. So this and then of course you recognize the 9/11 event. Okay, so predicate crime. Predicate crime is the crime behind money laundering. What are some of them? This is not the entire list. The European Union has actually identified 22 predicate offenses that can be associated with money laundering. So as there are new crimes, or as there are more, that I'm sure that over time we will actually have identified more as well. But in the meantime, these are all the ones that the European Union has identified, 22 of them at the moment, where it is considered to be related and identified to be something that they can be found to be guilty, and that there will be penalties as well as jail time involved in those. Okay, so we have the regulatory body standard setters and the board and the framework and the initiative, and these are some of them. The Bank of International Settlement that sets up the standard for central banks. They have the sound management of risk related to money laundering and financing of terrorism guideline, which is to enhance the effectiveness of supervision of banks. Then we have the Wolfsburg Group. The Basel Institute on Governance is actually set up they do a periodic update on the AML countries rating. So we have Transparency International that is driving some of the standards on a corruption index. We have the IMF, we have FATF, which you're familiar with, and United Nations. ICMON Group is the collective group of financial investigation units around the global FIUs. And then we have the Asia Pacific Group on money laundering. So these are some of the international regulatory standards, and where you have the standard setters. These are not regulators, these are standards, and they are the ones who will drive all the regulatory work and initiative. And then the countries will all then look into the legislation, and then after that the second layer of legislation. So country legislation will be your law on the various laws that you have, the banking act, or you call act, or and then after that, there will be the central bank guidelines and all that. That will be the secondary layer of legislation. So, and then you have the rules and regulations that come in, and then industry best practices. So industry best practice is actually what the Wolfsburg Group does. The group recommends all these best practices, including the correspondent banking questionnaire, which I also asked during the survey, is how how familiar you are with the Wolfsburg questionnaire. So these are some of the best practices that have come out. And GCFFC, the GDF, which is the Global Digital Finance, we have also created our own guidelines and also some of the checklists that can be used as well. So if anyone is interested to know more about the Virtual Asset Service Provider questionnaire, you can ping me as well, drop a question, and I can send a copy to you as well. And in fact, at the back of this slide, you will also have a list of the resources that you can also go into, take a look at them, and I will run through them if time permits. Okay, so what is the Financial Action Task Force? This is the big brother, or which is an intergovernmental body set up by the G7, and that's why the FATF head office is actually in the OECD building as well. So they set the standards and they promote the effective implementation and legal regulatory operational measures around combating money laundering and terrorist financing. So over this period of time, what we have noticed is that the narrative globally has changed from not just about fighting money laundering. It's no longer just about combating terrorist financing or money laundering. It is now moving towards fighting financial crime. It's not just about money laundering, it's about getting to the root of it. And then we have, of course, the Financial Action Task Force style FSRB, as we call it, the Asia Pacific Group on Money Laundering, of which many of the countries in the region are part of, where they serve to conduct mutual evaluation, to look at how good they are in terms of complying with the FATF recommendations, the 40 standards, the 40 recommendations, as well as the recommendation on the effectiveness. There are 11 of them. And then they offer technical assistance and training as well. And they do typology research. In fact, the Asia Pacific Group, there's a recent typology research that was published by them as well on the various crime that have been detected. And also all these public-private partnerships. And Wolfsburg, this is it originally consisted of 13 global banks. Now it has become 12 because Credit Suisse and UBS have merged, and they are the leading voice in the banking community to fight financial crime. I think this is probably the first time that we hear about combating financial crime in totality rather than just talking about money laundering. So it helps to shape the policies and policies in financial institutions as we move towards it. So Wolfsburg questionnaire, when it was first implemented in the early 2000s, it was just across the large global banks. And over time, for some of us who are dependent on correspondent banking relationship with international institutions, would have encountered where these banks who are acting as correspondent to us for all our US dollar, our major currency clearing, they would ask us to fill up a questionnaire, and the questionnaire is actually getting longer and longer. You know, it started from just a very short questionnaire. It has now probably blown up to about 400 lines. And the Virtual Asset Service Provider questionnaire, which is mirrored on the Wolfsburg questionnaire, has even more lines because it is such a huge space when it comes to crypto and virtual assets, digital assets. So and it promotes Wolfsburg promotes the engagement between public and private sectors as well. And so this is how the Global Coalition to Fight Financial Crime has also come in, is also to enhance further the engagement between the public and private sectors, because Wolfsburg focuses more on the banking sector, while the GCFFC looks at more than just the banking sector. So it has membership from a wider variety of institutions. And okay, so now we come to the correspondent banking proper, and why is it important? So let's first look at the definition. Correspondent banking has been defined by FATF as the provision of banking services by one bank, the correspondent bank, to another bank, which is the respondent bank. So it is basically just as a background, I used to do correspondent banking advisory when I was in one of the global banks, and my clients were banks who are using our facilities to access into the global economy and also the global major currencies. So it allows the banks to provide services in global currencies in the local jurisdiction where they may not have access to it directly. And then this is to facilitate trade. So it connects banks from in different region as well. So this is actually a brief history of cross-border payment, how it first started. It was first recorded was a cross-border payment between England and France. That was in 1817. So you can imagine how long ago trade has happened. And I know even in the Middle East, still until today, I was in Dubai for 8 years, and I could still see barter trade happening at the Dubai Creek. Okay, so maybe a show of hands, if anyone or someone in the chat, have you watched MI for Mission Impossible 4 starring Tom Cruise? So Tom Cruise in the Mission Impossible 4, he was kidnapped and put onto a boat in what you will see as a river, but we call it the creek. And this is actually where, and if you recall, the Mission Impossible 4, there are people moving goods up from the boat onto shore at the river bank. And that was actually where the barter trade happens. And then, so that's trade. In modern days, there are still all this barter trade happening. And I'll talk more about that in a different session when we talk about sanctions. And okay, so then the international transfer system was then established between England and France. And interestingly, in Asia, I think HSBC, the Hong Kong and Shanghai Banking Corporation, was probably the first international bank that was set up in Asia. And it was set up in 1865, I believe. On the 3rd of March, that was the anniversary, 1865, HSBC was set up to facilitate trade between Europe and Asia. So, and then after that, IMF was set up, World Bank was established, that was in 1944, and so on and so forth. So this is how the entire cross-border payment has happened. So so look at 2011 was when TransferWise was the first fintech to do cross-border payment. And in fact, I think TransferWise has just now rebranded as Wise, is now a SWIFT member as well. So, and it's really interesting. So common correspondent banking structure is where your customer does not have direct access. So say, for example, I will just use a bank that we just mentioned, HSBC. So say, for example, a bank in Indonesia, right? And it's a local bank in Indonesia, Bank Mandiri. So they do not have direct access to US dollar clearing. And what they do, they are the respondent, Bank Mandiri, and then the correspondent banking being HSBC. So the customer of Bank Mandiri would not have access to HSBC US. What they do is they will make use of Bank Mandiri to do the trade for them. And then this is the direct relationship of a customer to respondent bank, to the respondent bank, and to the and then into the international market, and that's for to facilitate trade. And then you will have those where you have a respondent bank, say for example Bank Mandiri again, and they will have smaller post office banks and all that, making use of Bank Mandiri because they are the ones who have relationship with HSBC while they don't. So these are the ones that are actually making use. Their customers in those smaller banks, local banks, will be the one that will have access into the larger regional bank who will have access to the global bank. And this is where the nesting happens. We call it nesting, or we call it downstream banking, where you would have all these smaller banks connected to the global economy through a respondent bank, through a correspondent. And then there are those that allow for payable through or pass through. This is a very common question that we get. This is actually a question in the correspondent banking questionnaire, where we ask our bank customer, do you offer payable through or pass through? That means that I don't even so if, say, for example, I am the regional bank that has access to HSBC. I will have all these other local banks that basically I will allow them to make use of my channel to go to HSBC, and I don't do anything about it. I'm not involved in it. I just open my channel and allow for my clients to access to the correspondent banking platform. So this is a very high risk product, and all correspondent banks are really worried about it, is that there is no additional layer of due diligence by the respondent, so that there is actually some control in place. So all the time that I have seen, our respondent banks answer would be, no, we do not offer this kind of service. And this is the response that actually a correspondent bank would rely on when they do business with the respondent bank. So respondent is the one using the service of a correspondent bank. The correspondent bank would be the one that is offering the global access to the financial sector, to the financial industry or the system. Okay, so cross-border correspondent bank is how it works. So you have, say, for example, a user, a payer, a customer, a retail customer in Kenya. They would make use of their they will make use of the local system in Kenya to make a payment into, they want to buy something from Indonesia, for example. They will make a payment to the institute, their own bank in Kenya, through the payment network to a correspondent bank, say, for example, Standard Chartered in Kenya, to do the transfer of money to HSBC, because Standard Chartered has a relationship with HSBC, for example, because HSBC is present in Indonesia, so they might be doing trade in US dollar. So from Standard Chartered Kenya, go into HSBC Indonesia through the payment network, and then go into Bank Mandiri, where the recipient holds an account. So far, so good. Any questions so far? Is everyone able to follow? Any questions? I don't see any questions yet. Right. Okay. So how are we doing for time? Great. So therefore, what is the risk of correspondent banking to the correspondent who has a direct access into the global financial system? The correspondent generally does not have a direct relationship with your end customer, the underlying parties, and they have very limited information. There is no due diligence done. I mean, they can't go into know your customers, right? So they will have very limited information being done on this particular end customer, and so they are not able to identify their identities. They will have to rely on the controls of the respondent banks, so that they are aware, or they have to rely on them and say that, okay, if the respondent banks has actually got established all this AML program, this anti-money laundering standards, then I'm comfortable to do to conduct business with you. And that's where we have this concern about this de-risking. I think the first time when I heard about de-risking was when I was in HSBC at that time, probably in the early 2010 2010 was the first time, 2010 was probably the first time I heard about this risking, because, you know, the risking at that time was very much around not about exiting some of the bank's relationship, because looking at the risk, de-risking some of them, and not doing business with this relationship, not doing trade with them, not offering trade facilities or foreign exchange, foreign currency access to these banks, because of the risk involved, because we just don't know whether, you know, these banks are actually having the controls in place that we can rely on. And then and so where there's also where, you know, when you are actually operating in very different legal framework, so there's a lot of regulatory arbitraging happening within the jurisdictions as well, and applying to different standards. So this is where all the global banks have actually followed the FATF standard and the Wolfsburg standard. So this is where and driving the entire global finance sector into applying to those standards. And I know that especially in our region in Asia Pacific, some of these standards may appear to be really difficult to apply. We may not even be able to comply to it, because they are just miles apart in terms of our geography, in terms of our language, in terms of our geographical geography diversity, and I think in particular in the Pacific Islands, you know, there's so many islands. I was recently in Philippines. Philippines has about 8,000 islands and 2,000 of them inhabited. Indonesia has about 18,000 islands with maybe 6,000 inhabited or more. So these are the kind of condition that Asia faces as compared to the countries of FATF and Wolfsburg, where, you know, they have a big country with less of these situations to manage. Language, I think, in Asia is probably the biggest challenge as well, because not everyone here in Asia would speak English. And then it makes communication even more challenging. And when I was doing correspondent banking advisory, I used to travel around the region. I was covering Middle East and Asia. So, and I had faced challenges where our clients, the respondent banks, when they have this discussion with us about their anti-money laundering program, they would need a translator to sit next to us, because otherwise they would not be able to complete the questionnaire. And so typically the person who is the translator would be the relationship manager, who generally knows more English than someone who is in the back, who doesn't really need to know to be able to speak English, because they can do their processing, they can do their risk assessment review in their local language. So that is actually a very real challenge in our Asia environment, where our languages and everything is not homogeneous, including the regulatory maturity as well. So, and of course, you know, as just now we mentioned, and I showed the entire road map from the beginning of cross-border banking to all the way into fintech. So introduction of new payment methods in the form of fintechs and in the form of virtual asset service provider has made the correspondent banking environment even more challenging. And so when I like to also stress this, that correspondent banking, while the word bank is there, now with the new payment method, we also need to we also want to have this in place to remind ourselves that this is actually talking about a financial system. It's not just going to be about banks. It's also about the fintechs. Okay, so breaking down further the challenges, as I also mentioned earlier, is about all these. And the de-risking has actually led to a lot of unintended consequences. And what we have also seen is that a lot, because of the lack of correspondent banking facilities in those countries where de-risking is happening at a very rampant pace. Not just in Pacific Island, we are seeing that happening in Africa. I may actually have a participant from Africa joining us today because she would like to also understand more about correspondent banking. Middle East, it is happening as well in the Caribbean islands. So de-risking is a global phenomena. It's also because of the concern of this global bank of being fined. You would have read about all the fines that happen in the billions of dollars because of poor internal control when it comes to money laundering, and also even reaching the sanction laws around the, all the United Nations and the United States sanction laws, OFAC, right? So that's where it has become a real challenge for and in fact, interestingly, the IMF departmental report on the rise of digital money for the February 2024 actually focused on the implications on the Pacific Island countries, which highlighted that several of the Pacific Island countries have actually exhibited weaknesses that could threaten the integrity of the financial system. And therefore, I think that's where the risking of correspondent banking has happened quite rampantly. This is from the AML perspective, and hence, it was difficult to maintain correspondent banking relationships. And the unintended consequences is actually driving a lot of the cross-border payment into the gray areas and into the shadows, where people start to use the unofficial methods of doing transfer of funds across border. I saw that happening in Nepal. I saw that happening in across Middle East as well. What I think the very common term being used is hawala. Hawala is unlicensed money changes or unlicensed exchanges. So when it comes to unlicensed exchanges is where it poses a problem. It also poses a concern whether or not our consumers are being protected. Could they fall into fraud and scam when they transfer the money through unlicensed or unregistered or unregulated institutions into another country? Their hard-earned money being taken away, being scammed, or and then the families back home do not get access to the money that they have earned because of the use of all these unlicensed channels. And so what is actually the expectation of the respondent by the correspondent bank in order for them to have access to the system? Is actually a clear and open communication relating to financial crime matters. And this is where the questionnaire that was prepared by Wolfsburg, the correspondent banking questionnaire, comes into play, because this is where we have this dialogue to talk about the provision and accurate of due diligence information. And the response to requests for information has to be timely. So say, for example, if a correspondent bank actually has a question about, oh, okay, so we need to have more information about this an end customer that you have that is accessing our system. What is it that you are looking to, what exactly are you, what do you call it? What exactly is it? What kind of documents do you have? So what the correspondent bank would require is actually the information with regards to those transactions to make sure that we have proper screening being done. This is especially the case with trade finance. And it's also important for us to understand the institution's risk appetite coming from a correspondent banking angle. Is that, say, for example, if the respondent offers services to virtual asset service providers, so what kind of controls do you have in place to ensure that these crypto exchanges, I will loosely use the word crypto exchanges just to make it simple, because virtual asset service providers can be anything that is just offering services for virtual assets. So a crypto exchange, for example. So if a local bank is offering a offering services to a crypto exchange, what kind of service risk appetite do you have? What kind of controls do you put in place? So these are the expectations of a correspondent bank about what kind of risk appetite you have. And so I always like to use this analogy, the 3 lines of defense. This is one of the formation, quite an old formation, as people may guess from here, is that I kind of like a fan of football. And this is football, soccer. And I guess a lot of people would watch World Cup. So we talk about the 3 lines of defense. You have the first line of defense being your relationship managers, the front line that faces the customers, and then you have the defender, and then you will have the goalkeepers. The goalkeeper is at the end, right? So, well, the thing is, we all work as a team. So while the front line is trying to get the ball into the goal, they basically on the attacking side, getting business in, they are also the front line to help to assess the customers. They're the ones who are facing the customers. And therefore, you know, when they face the customers, they will be able to assess the risk that is posed by this customer. And now this is actually it's very similar to being in the correspondent banking ecosystem as well. So you will have the respondent bank actually at the front, where the respondent bank is the one that would know who the customers are, the underlying customers. And then from there is where we are that the correspondent bank would rely on the respondent bank to have all the internal controls in place and the due diligence being done on the customers before it passes through. So then when it passes through, then the other layers of the correspondent bank would be all the tools or the screening that is there in order to prevent or to detect money laundering or to prevent sanctioned transactions from going through. So everyone works together to form one team with all the 3 lines of defense. So then from a correspondent banking due diligence perspective is where we talk about the risk-based approach. So we don't apply the same standard to all the customers. It would depend a lot on the customer risk, what kind of customers that you are serving, right? And then it would depend on the geographical risk. And so like the Basel AML, they have a set of the geographical risk, as in they will have the country risk, AML risk table. And then for the geographical risk, and then the product and services that you offer. So could it be trade finance? Could it be foreign exchange, and then the transactions and the delivery channels? And just now I touched a little bit on the correspondent banking due diligence questionnaire, and then also a shorter version of it, which is a financial crime compliance questionnaire, which is the lower risk. Other than, I mean, deep risk is being used, designed to address the relationships other than for those deemed higher risk. So with that, right, it's a convenient stop for me to just pause a little bit and ask if anyone has questions. Maybe we'll take a 5-minute break as well during this time. Let's have a 5-minute break for you to also digest some of the things that you have listened so far, because that, and also to allow you to ask questions. Please post your question on the tab Q&A, so that we can go through it, and then after that ask the questions. And I hope you also have you're able to access the parking lot, which will be open. So even after the event, because while we are able to answer some of the questions in the Q&A, the parking lot will enable you to continue to ask questions. It's open until tomorrow, so that I can pick up the questions, and in our next session, maybe we'll spend the first 5 minutes going through some of the questions that is in the parking lot, so that, you know, as I mentioned, that is also where I can get all your questions and build the content. So 5 minutes from maybe we come back at 8:10. Oh, sorry, 5 minutes from now. So my time is 8:05. So come back at 8:10. And in the meantime, please post your questions on the Q&A, and I would love to have your comments as well in the chat.
Hi, Julia. If I may, just for discussion purposes, through interactions with some Pacific banks and colleagues from Pacific banks, we hear from colleagues that the bank is meeting all the requirements of the regulator in country, and yet they are faced with challenges in accessing correspondent banking services. Would you want to speak a little about that in terms of why that would happen?
Yeah, so I think this has happened is also because as I meant as it was mentioned earlier, is actually where you have country risk being involved. And so what happens is that okay, so I'm just going back to the slide and to show you what I meant by that. This one, right?
Mhm.
So you see here is that while you have already complied to all the regulations, what the bank could also be looking at is the customer risk that you have. So it's not just about complying with it, but also say, for example, what kind of industry the respondent bank services. The geographical risk, of course, is one of the major area that is considered. So from a risk-based approach, a bank would be assessing a customer. So there will be, say, for example, 5 categories, A, B, C, D, E. So A being the lowest risk and E being the highest risk. And so when you look at it from that perspective, is that you, based on your geography, based on the product that you offer. So now from an AML perspective, loans would not be considered as a high risk item because you have a lot of transparency in loan repayment, where that one is coming from. You know that the customer would need to justify the how they are getting the loan, how they're going to repay the loan, right? So the source of fund is quite clear. But when it comes to those products that are considered of a higher risk from an anti-money laundering or sanction perspective, or okay, money laundering perspective, would be cash-related transactions, and global banks, especially in that are offering euro, pound sterling, and then US dollar in particular, is that they also have to comply with the OFAC requirements, and OFAC is pretty stringent, as we all know it. And the Department of Justice, when the fines come, it can be really heavy. It comes into the billions. So when you consider those kind of concerns, is where, especially if the volume of transaction is not high, and the pricing itself is, it doesn't commensurate with the risk. So if a bank is considered, a respondent is considered to have a higher risk, and then that naturally I would want to be able to charge a higher fee. But then a higher fee also doesn't, it's practically not possible for the respondent bank. But on the other hand, and on the other hand, the volume is not high enough. So it is a really tough decision to be made as well, whether or not, we continue to bank this respondent bank that may be loss-making for us from a risk perspective, because, I'm being exposed to a lot of risk. I could be fined if I need to, in order for me to not get fined, I need to put additional internal controls in place. I need to specifically monitor this particular bank. So that is causing a lot of the global banks to also say, you know what, I really can't take on this risk. This is too expensive for me. So that's why, although, you know, while on the respondent banking side, we have complied with all the regulations that we could, from the risk perspective, I'm still not able to meet those standards of that is expected of the global banks. I hope that answers your question.
Thank you for that, Julia. So if a bank is able to sort of do all that is possible to mitigate risks from its own perspective, what can a country's regulator do to help reduce a country risk?
I think this is going to be
perhaps one most important.
Yeah. So on the central bank perspective is, of course, first is the mutual evaluation report that is conducted either by FATF or by APG. That is of utmost importance, and we know that any country that goes into the grey list, it is deemed as of the highest risk, and so a lot of correspondent banks will be really very very vigilant about them. And you are on a grey list on as far as the geography is concerned or the country risk is concerned. I think naturally you'll fall into the D or E category. So from that is where then we will go into the FATF and the FATF 40 recommendations. And then also now it's not just about the technical competency complying with the 40 recommendations. There are also the immediate outcome that is on the effectiveness of supervision. So the effectiveness is something that would need to be assessed as well. Well, the MER, the mutual evaluation does do that, is on the effectiveness. So on that also, we have the Basel, the BIS has actually come up with a standard on sound implementation by the supervision, sound supervision, I'll call it, in short. So we have all these in place, and I think central banks, I can really appreciate the challenges there as well, having to balance the local environment and also to meet those standards in terms of sound supervision, how that is being done.
Okay.
Sorry. Go ahead, Hugh.
No, I don't see any questions posted by our colleagues while I guess we chatting away while or using up the break time. Just out of interest, right? There is this guidance where countries that are larger, 5 billion plus economies, their chances of getting listed are higher, whereas smaller countries such as Nauru, they might not get listed because of the relative size and the risk they bring to the international finance system. But in that case, then how important is the mutual evaluation report?
It is still very, I think the mutual evaluation report is what would drive whether a country goes into the grey list. So it is still from whether or not a country is big or small, we still have to look at the compliance with the technical competency as far as the 40 recommendations are concerned. So just I think the MER itself is important, but how we address the MER is going to be something that I feel MER will definitely be important in terms of whether or not a country is considered to be competent. So then the next step is then how do we ensure that we meet those expectations? A big country or a small country, they will have to meet those expectations. And of course, when it comes to meeting those expectations, is where we also look into our own national risk assessment. I believe that is one of the requirements that every country would have to do that. Hi, I see Rajas has raised his hand. I'm not sure whether I am able to unmute him.
You should be able to.
I am so sorry. I am just not so good with the system.
Can you hear me?
Okay,
Yes,
Rajas, okay,
Ravi,
okay,
yeah.
yes.
Okay. You raised that important issue about the MER technical compliance. One guarantee is that despite achieving good results in the MER, you still don't or are unable to get corresponding banking services. The national risk assessment, we have already done a national risk assessment. We know the risk is low, relatively low. The first MER in 2000 found Nauru low risk for money laundering and TF activities, but still we are unable to access correspondent banking. So what guarantee is there that despite having received a good outcome in the MER, that we will still not be able to, we will still not get the corresponding services we require. This is entirely, I have corresponded with FinCEN themselves because the correspondent bank is based in US. What role does the regulators have in that? We are still unable to get correspondent banking services, which is a very, very huge disadvantage to now. Thank you.
Thanks, Rajas. That is a real concern. I think from a central bank perspective, I believe from this perspective, unfortunately, I would not be able to really comment from a central bank perspective. I can come from my perspective is that this is where it is important to have those G2G, the government to government conversation on opening some access of, actually this is where it plays an important role is to have a G2G conversation, even a direct pipeline. And then it's not going to be easy, I'll say, even when we put in those direct G2G relationship, which I am seeing a lot of that happening, especially with country like China. There is a direct G2G with PBOC, and so on that is where whatever controls that are expected to be put in place are put in place according to the agreement that they have. And so the diplomatic or the G2G relationship is what is going to play a very important role in this, rather than to go on an individual bank basis. That is going to be challenging. It's definitely a G2G conversation. And having said that, the Financial Stability Board has actually is coming up with some guidelines on financial inclusion, as well as de-risking. Of course, this de-risking, the guidelines have actually come out more than 10 years ago, but it's still something that is being looked at and being reviewed. And I know that from the Financial Stability Board is, in fact, Wolfsburg and FATF are looking into issuing further guidelines and on this area as well. And I am not privy to those information, except that in the most recent FATF plenary, there has also been discussion about the de-risking issue as well as the financial inclusion. And we possibly should be seeing some papers coming out soon. And from there, we would also be able to, I think, strike that dialogue on how to carry this forward. I'm not trying to paint a rosy picture here, but definitely from my understanding is there are a lot of discussions happening at FATF and Wolfsburg on how to take this forward in terms of setting the standard and the framework.
Thank you, Rajesh, for that question, and Julia for your response. I understand that your suggestion that there has to be a lot of government to government conversations on the requirements and the need to meet the requirements or the differences in requirements between the two jurisdictions. So we will take that response and see how we can assist various countries with the G2G dialogue as well. Thank you.
Any other further questions?
I believe we've used the break time well, Julia. Maybe it's good to keep going. And if there's any questions, please feel free to post them on the Q&A.
Yeah, please do. And actually, let me just stop share. I wanted to see whether there are any questions that have come in, on the Slido for me, on the parking lot. So please remember to I still don't have any questions, I think, on the parking lot. Like I mentioned, it's actually going to be open until tomorrow. And so with that, even if any of you have any further questions during this time that you want, you please feel free to put that into the parking lot so that we can take it forward for the next session, right? Okay, so let's continue. So now I want to touch on the Wurzburg Financial Crime Principles. This is actually the master document that the reference is in the slide, which I'm going to share to you after the event. This is actually the principle behind correspondent banking. So it was this was updated in 2022, and it deepens the definition of correspondent banking, because when correspondent banking concept was first introduced, every financial institution or every bank-to-bank relationship is considered as a correspondent banking. Then it became very challenging, that because not all the products are the same. If you are just doing a SWIFT exchange RMA only, it may not be you are just doing a SWIFT message exchange. It may not necessarily be correspondent banking. Correspondent banking relationship would be those that would involve trade, would involve transfer of funds, right? So that's how the Wurzburg questionnaire has actually, the Wurzburg principle has actually broken it down, identifying it further, what is correspondent banking. Therefore, the CBDDQ, which is a correspondent banking questionnaire, versus the FCCQ, which the Financial Compliance Questionnaire was formed. So they split it into two. One is for the higher risk, the other one is for the rest. So then the principles also drive the responsibility and the oversight. Who is responsible and oversight? And this actually talks a lot about the governance of the respondent, the requirement for the governance of the respondent, the responsibility of the directors and all that. And then it talked about the risk-based due diligence. So this is where it was the beginning of the risk-based. So not all. It will be, of course, as you see, geographic risk. I think Nauru, if it's already considered as a low-risk jurisdiction, then that is probably an area that that is already something to be celebrated and something to work on. Is based on the geographic risk. And I think it's also quite interesting that in the Caribbean, as well as the Channel Islands and all that, geographic risk, Cayman has just recently been removed from the grey list, right? I think some of the other countries, it's also because of the offshore facilities. And the concern with offshore facilities is where in the next session, where we talk about the customer due diligence, I'll also share a little bit about the offshore, the risk of being an offshore center, offshore financial center, where some of the money laundering happens, as was seen in the case of the $3 billion arrest in Singapore. There was a lot of offshore activities as well. So then we look at even in this principle, it drives own branch, subsidiary and affiliate. Even say, for example, Standard Chartered own branch and in the rest of the other countries are also captured in this, that it has to follow certain principles and due diligence requirement. So, and then of course, there may be say, for example, Standard Chartered having a relationship with HSBC UK, HSBC Malaysia. So these are also, because they are in different jurisdictions, they will also be subject to the due diligence requirement of the Wurzburg. Then comes identifying what kind of products and services, the customer base, as I mentioned earlier. Customer may include some of the customers that are of a higher risk category. And then you have the regulatory status and history. I think this is where, you know, it comes to how the central bank can actually. So one of the things that we had always challenged, I was actually in the front line. I wasn't in compliance when I was doing correspondent banking advisory, is that there is this question asking us to assess the suitability or the regulatory standard of the country. And we will always push back with the compliance team and say, look, you know, it's not for us to judge the regulatory standard of another country. You guys go and do it yourself. I am not going to comment on the central bank and how good they are. So it's actually one of the questions in the questionnaire, in the Wolfsburg questionnaire as well. And then, of course, you know, there's a need to assess the financial crime control. And also, I think it is probably now quite well known that the most financial institutions, most banks that I am aware of would not have any business arrangement with shell banks. What do I mean by shell banks? It's just a licensed entity with no physical presence, with no people. It's just a bank that is licensed in a country where it's allowed to have all these licenses. And then after that, you know, there's actually no activity in there except except for the making use of the banking license. So these are the shell bank. And in a lot of financial institutions, they also ban, they will also not bank shell companies. So I think shell companies is possibly something that is quite familiar to a lot of us, is where, you know, a company is being incorporated as a booking center. You book a lot of activities in there, but with no operations. And then Wolfsburg even directed, which is why Wolfsburg actually directed that we should do a customer visit to make sure that this is actually it has a real physical presence with staff in it, not just a registered office. So that's why the customer visit became a requirement based on the Wolfsburg principle. Then there was also, then the principle also highlighted the importance of enhanced due diligence. So whether or not there's PEP involvement, there are some countries where it's quite common to have families own banks, because, you know, in the good old days there, I think even now, owning a bank is actually a status in the society. So there may be all these big families that own and also who happen to be also politically involved, who own banks as well. So whether or not the respondent bank has any PEP politically exposed persons being involved in the management of the company. And then the other concern that we have is on the downstream, the nesting. So if I am if the respondent bank is actually having opening the banking facilities to, say, Money Service Bureau and all that, right? So and because the Money Service Bureau doesn't have direct access to the correspondent bank, what kind of controls and due diligence is being done by the respondent bank on these financial institutions or the non-bank financial institutions that may actually expose the correspondent bank to certain risks, because they do not know the underlying customers. Then the principle also highlighted about the requirement for monitoring and reporting. So this the principle is actually quite I'll say actually quite simple, in the sense that it is just it's not a thick document, but the essence of it is that each of the correspondent banks will have got to establish the policies and procedures based on this principle. And then the integration, now then it also, the last part is quite common in the past, that the correspondent banking function, the due diligence is separated from is actually managed in silo outside of the financial crime compliance program. And so what the Wolfsburg is saying now is that, hey, you know, this is part of the financial crime compliance program. Don't look at it separately. And in fact, you know, if your financial crime compliance program is of a lower standard to your correspondent banking due diligence program, that means that you have to uplift the entire program across the enterprise or across the entire organization. So far, so good. And so these are the sections that are in the rules book, group correspondent banking due diligence questionnaire, which is the tougher one. So these are the sections. Again, I've put in the reference in there. You can go in and take a look and see how extensive the questions are. So you have the entity, it will ask about the entity, about the product, about the program of the respondent bank. So this is a questionnaire that is prepared for a correspondent bank to ask those questions to a respondent bank. So this is where one of the thing is on training and education, which a lot of in the past, what during my stint in the advisory is that I did notice that there were a lot of financial institutions that were not paying enough attention to training and education, and then in fact a lot of them think that the what here, how do I say it? Training of financial crime compliance is only meant for the compliance team. But actually, as we now see it, right, looking at the football analogy, is that it's actually the 3 lines of defense. All of us need to be trained on anti-money laundering and sanctions program. It's just the depth of it and how what the level of expertise is needed. So training and education is definitely a key point to it, and which was also why my first discussion with Hugh was I asked him, has everyone been trained on anti-money laundering? So this is how the entire program was mooted, is let's start with doing some training, getting the awareness out, and then we'll see what else will come from it. And then on that, which is again why I wanted to do that survey, is also to understand what is needed. And parking lot is to see what kind of questions that we want to address during and build the content around. And so actually, I wanted to also, on that note, right, just now, as I mentioned, was you saw this screen earlier, but it was only the nested, you will see they're all banks. But now with the new payment methods that have been introduced, you have your fintechs, your payment service providers, you have your other and non-bank financial institutions, your fintechs, and your banks, and virtual asset service providers, actually, which I will lump into the non-bank financial institutions. So you have all these other new payment methods that have come into and then banking with the respondent bank. So it actually increases the risk. Why I say that is because fintechs innovation is happening way faster than regulators are able to catch up. Even compliance professionals are able to catch up. So I always laugh that as a compliance officer myself, I need to be a data engineer. I need to be a data scientist. I need to be an engineer. I need to know how to fix the machine. I need to know coding. And this is where, in the new world of fighting financial crime, we need to get everyone together. It's no longer going to be because I know anti-money laundering, I know compliance, and therefore I can just do the job myself. I need to rely a lot on a lot of the experts on the ground who are actually building the system, who are actually doing the data analytics. And because of the rampant fraud and scam, something that is, there was also a comment, I remember there was feedback about the concerns of ethical use of AI. So we could possibly have a little bit of a discussion around that as well, is where I'm actually quite excited about financial institutions having those AI is going to make use of this information, the customer behavioral analytics, to be able to prevent fraud from the onset. Because, when you are able to identify that, say, for example, a customer suddenly used to be only, spending $100 a month, all of a sudden, you see the person transferring out $10,000 at one shot, and then that this is not the norm. you'll be able to trigger it, and then you are able to ask all the questions. So this is actually where, when I say, when I mention about fighting financial crime, this is what I meant. This is something that is very close to my heart, is that it's not just going to be preventing it, to detect money laundering when the financial crime has happened. It's actually going to be making use of all this technology that we have to fight it from the onset, to fight it in the front. So the football, 3 lines of defense, this is going to be applicable across. And so you see new payment methods, and especially for respondent banks, that having relationship with all these fintechs is something that we have got to be aware of. And in fact, this is why the virtual asset service provider questionnaire, which is based on the Wolfsburg, was designed. And it was first introduced to all the banks, the global banks, so that they can start looking into how to assess the risk of a virtual asset service provider. And it could be something that you can look at as well. I will also put that resource in, I think the resource is already there, in the link, so that if anyone is interested to look into the Wolfsburg style virtual asset service provider questionnaire, you can also take a look at it. It's very similar, except that it's way longer. A lot more questions. So, fundamental of anti-money laundering concept. So money laundering, there are typically 3 layers: placement, layering, and integration. Then placement is where first, how the money is first put into the banking, introduced into the financial system. Now, all of us are now wiser to the way that is being done. So, we have all this cash transaction reporting and all that being put in place. So, and so if there is any amount that is above a certain threshold, say, for example, $10,000, there will be cash transaction reporting that needed. There will be more information required from the customers. So a lot of the bad guys now, what they do is they will introduce money mules into the system. In fact, there have been a lot of money mules that were caught in Singapore. A lot of them are even students, teenagers, and they were charged in court because they allowed a third party whom they barely knew to make use of their bank account to place money into the system. And let me just say this, is these people, it's not because they meant to do anything bad. So imagine if I'm a mother who has a child who is sick, and I don't have money and to pay for medical bill. And if someone comes and offer me, hey, can I use your bank account because I just need to park 100,000 in there, and I'll give you 5,000 as a repayment for rent of your bank account. Would I do it? To be honest, I would. Right? Because that is the kind of situation that we cannot deny a lot of the people are facing. Of course, also a lot of them may not be so knowledgeable in terms of not regulations. They may not even know that this is money muling, this is illegal. So this is something that in the front line we need to look out for. One is to protect our customers from being used to be exploited. The other one is, of course, to prevent the bad guys from making use of the system. Then once the money gets into the system, into the banking system as the placement, then the layering will happen. The money get transferred here and there. And then after that, the integration is when they will make use of this funds that have gone through multiple layers, so that it would hide the origin of the source. And then they will start buying real estate, they will buy cars, they will buy luxury items and all that. So to integrate into the system, and then after that they sell it, right? And this is where NFT, non-fungible tokens, at one time we were really worried, is that non-fungible token is that it is really willing buyer, willing seller. So it may be a very high price that you're looking at. And then after that, and then they sell it back at a high price, and then you make the money out of it. So that's where the integration happens. And then that's why we need to do the customer due diligence. We need to look at identifying suspicious activities. So customer due diligence is going to be a different a different session that I go through all together, that you will be able to see the fundamentals of it. And also hopefully we can do some exercise as well, so that we can do some exercise there, and then be able to you will be able to appreciate what it's like, you know, to do a proper customer due diligence. And then you have transaction monitoring. That is going to be another session that we have that specifically talk about transaction monitoring and to identify suspicious activities. And then looking at it from a risk-based approach, and on that one, I will also cover how to do the customer risk assessment, a methodology. I will recommend you a methodology and in fact a template on how to build your own customer due diligence risk rating. So and then on that, right. So at first I was thinking about doing a breakout, but let's do this. We'll just spend just a couple of minutes. I think we don't, in the interest of time, just put into the chat. Imagine yourself, you know, that group of money launderers in Singapore where the 3 billion was confiscated. Imagine yourself, those people. Devise a method to clean 1 million of criminal proceeds. And then, so yeah, just think about how you would do it. If you could place that into the chat, how you think that you would clean the $1 million of criminal proceeds. Let's see who will start first. If you had $1 million worth of criminal proceeds, right? I see people are actually quite shy. Or would there, is anyone, would anyone want to raise a hand and speak? I think I know how to, unmute already. Anyone want to speak? Oh, okay. David, let me unmute you. Go ahead, David.
$1 million is, I suppose, a place to start. I think I'd go straight to Tether and start with a crypto that's enormous, the largest crypto traded today, and that has been notoriously opaque in their ability to do KYC on customers. But I think that, I mean, the key is when we look into laundering, it has to be placed, it has to be layered, structured often, and that takes time. So I'm not going to go into a long explanation, but I thought I'd share something. So my answer is Tether or something crypto.
Yeah, thanks, David. I love that idea. And in fact, you brought up a very, very important point, a very critical point. Remember, I mentioned about nesting. A lot of times your customer, is how you would have customers that are virtual asset service providers. Where do you get Tether? It will be from the crypto exchanges, right? And so are we doing enough due diligence on the crypto exchange? And, you know, Binance has just recently been charged by the DOJ in the US for the lacks of for poor KYC control. Did Binance do proper due diligence on the customers that they onboard, right? So if I had this amount of money that I can just buy Tether, and Binance or any other crypto exchange, if they do not do proper due diligence on me, they may not know that I'm actually a bad guy. And they don't screen my name even. We'll talk about the screening in the next session on customer due diligence. So generally, no proper customer due diligence. So, and that if there is no proper transaction monitoring to know that this guy has been buying Tether every day, 1 million, 1 million, 1 million, 1 million every day, and nobody knows about it, right? So that's the kind of thing.
Yeah, if I could add just one more quick comment on my views there, which is I am pro crypto assets, and I think that USDC and other stable coins are really very appropriate. But my biggest question about Tether that I would place to you and to the group is, if it's so great and if they've got $100 billion in assets, which are in treasury bills held with Cantor Fitzgerald, why can't they get a bank in the United States? And if they, with their $100 billion in Cantor Fitzgerald held custodial treasury bills, can't get banking in the United States, what's the actual solution for correspondent banking? And is there one?
Yep. And this is where innovation comes in. And a lot of the thing is, we don't know what we don't know. And it's definitely why we are here today, is actually having those discussions, getting people to be aware. When it comes to correspondent banking, nowadays, it's not just about banks anymore. It's more than just banks. It's also about the fintechs, right? So yeah, I see there are actually a few. Yes, Isabel. Hi, Isabel. Isabel is my friend from Africa who is joining us today. Thank you, Isabel, for joining. Yeah, Isabel mentioned about watches and jewelry. These are things that I think Rolexes in the past decade has actually risen by a lot. And whoa, Rajas, you mentioned fishing industry. I really love to understand more about that. I think, as we progress into the sessions, I love to actually, I love to hear a lot more exchanges from the people during the time when we are doing all these sessions. Is actually the exchange. Now, the reason I would really like to have all these exchanges is because for me, I am not familiar with the Pacific Islands. And for all of you, you may actually be encountering different things. And so you see, from that perspective is where when we come together, we get a chance to actually learn from each other, not just from me. I'm a facilitator, right? And then, yeah, Samuel, you mentioned about church accounts. Yes, church being used for fundraising, religious schools, in fact, being used for fundraising, that's another issue that we are concerned about in terms of terrorist financing. It's rampant in this using charitable organizations to raise funds for terrorist financing is huge. And yeah, and in fact, on the watches and gold, this is quite interesting that I thought I should share this example. In South Africa, they used to, I don't know whether they still have it, they use gold coins. And so, the gold coins is something that you just put into your wallet. And then what they do is that they just mean that they just make it into the size of the gold coin. And then after that, once it passes the immigration, then they get it melted down into gold bar. So, I mean, it's just so easy when it comes to laundering money. And I'll show you some of the really interesting ways that we call it the Fujian gang. Oh, yes, David, trade-based money laundering through falsified invoices, under invoicing and over invoicing. That is a huge topic, which is a specialist topic on its own. I must admit that I'm not really an expert on trade-based money laundering. I'm more a generalist. And if there is any, we'll see how that goes on. I'll probably be able to develop content on that in future sometime, with collaboration with an expert on trade. So that one, and so generally, think about what you would do. It is just 1 million at the moment, and imagine the 3 billion would be, you just do it multiple times, you get your 3 billion, and then they integrated that into the system, right? And then, right, so we only have about 10 minutes left, and let's just proceed. So these are the common ways to launder money. You have trade, you have the cash-rich businesses, you have casino, gambling, and if there are some jurisdictions that there are some countries where gaming is legal, and in fact, online gaming is legal, is where we have all these challenges. So common ways to launder money. And this is the one. I've never heard of bear bricks before August 2023. The pictures, the picture, the bears on the bottom right-hand corner, these are called bear bricks, and they're worth thousands and even hundreds of thousands. And these guys actually had a lot. So you see, of course, they had cash, they had jewelry, they had watches, as Isabel highlighted as well. Then you have your luxury goods, wine. This is how you integrate your ill-gotten gains. So in the, well, we never thought about, you know, designating sellers of luxury goods as, you know, potential money laundering tools or businesses, right? And we would never have thought about toy shops. I actually walked past one of those shops when I was back in Malaysia, and they were selling bear bricks, and they showed my mom. And I said, you know, this thing can be used for money laundering. And she said, what? I won't even pay $10 for it. What's so big deal about it? But this is a collectible, and collectibles are very, very good tools for laundering money, because, you know, it is up to you to give a price. And that's where semi-precious stones, diamonds has a market, but semi-precious stone, where there is no market price for it, they are very, very good tools for laundering money as well. So in order for us to be able to fight financial crime, I think is to also put on the hat on how I would do it. So risk identification and assessment, I won't go through too detailed into it, but basically this is how we would talk about risk identification and assessment, and more detail of it will come in the next module, which is on customer due diligence. And yeah, I mentioned earlier about, David, your comment about Tata, so your NBFI, your payment service provider, be coming into the respondent bank, we need to do the deeper dive into that. And our role in conducting due diligence. So now let's think about why all of us have got to do it, especially the front line, because the frontliners are the ones who actually know the customers and the behaviors. And it's not just about looking out for money laundering, but also looking out to protect our customers. So say, for example, an old lady comes into the bank and says, I want to withdraw all my savings to give to my long-lost nephew. I think I mean, there have actually been instances like this happening in Singapore, where the bank teller was able to say, oh, that doesn't look right. Then they dug deeper into it, and they found out that it was that poor old lady, very lonely, and then found a long-lost nephew who spent a lot of time with her, and she decided to give all her money to him to invest in the business. And then I'm sure if she were to give the money to him, the fellow would have gone the moment he took the money, right? Well, that's why it's not just about preventing bad guys from entering the system now, it's also protecting our consumers. And so with that, we can say that, you know, we are basically the eyes and ears of the community and the law enforcement. I am going to quote, this is actually a quote from Shiu, that we are the eyes and ears of the community and the law enforcement as the first line of defense, and also on filing suspicious transaction reports. And on this one, there is a module that will be on filing of transactions report as well. And we will also go through on, you know, some of the challenges our financial intelligence units are facing when they receive our STRs. Is they don't even know how to go about doing it. Quality STR is important. The $3 billion money laundering case that we had in Singapore, it was investigated over the last 2-3 years at least, and it started with the banks filing suspicious transaction report. So when one bank files and then another bank, you know, of course, the fraudsters will not be using the same bank all the time, right? They will have multiple banks happening at the same time for layering as well as integration. And so when multiple financial institutions are filing suspicious transactions report is when the FIU has all this information. They put the pieces together and they were like, and then Interpol was involved as well. And then they got cross-border. They have even now confiscated land and properties in London. And I think they have confiscated properties in Australia as well. So this is how important filing quality STR is. So this is the one that I mentioned. Oh, we are on time. So these are the resources that I've actually put together. Before I distribute this, I think what I'll do is I will also create a link for the virtual asset questionnaire as well, so that you would be able to refer to these documents and then talk about how this will be the reference documents that you can use going forward. So with that, this is the end of my presentation. Perhaps I could open the floor to everyone to if anyone wants to ask questions, to make comments.
We'd also appreciate suggestions for the upcoming webinar series as well, in terms of how you want that tailored. And just while I have my microphone on, Rajesh, when you mentioned that Nauru is low risk, question to take away today would be, what are we doing to keep Nauru as a low risk jurisdiction? That's something maybe we discuss in due course. Thank you.
I see Dennis has put up his hand, or was it for an earlier? Dennis, you put your hand up earlier. Dennis Heather. Dennis? Okay, so I appreciate that there would be people that are actually joining from the room. Given that we will be issuing the certificates of participation, could the representative actually collect the names so that and pass it on to ADB, so that we would be able to issue the certificates to all of you who have attended at least 75%.
Thanks, Julia. And a great suggestion from Darren on the question and answer for the money laundering to fund a Hollywood movie about money laundering.
Oh, yes. The Wolf of Wall Street. And well, actually, I'm Malaysian, and so this is one MDB is definitely a topic very close to my heart.
We don't have any. We got a question from Johanne Kaisa. Not a question. Okay. Johanne, thank you very much. We also appreciate your time to join us today. And we'd like to get more feedback from you, more suggestions on how we can tailor these upcoming webinars. There's 6 more remaining, but going into details of each of the topics, and how we could maybe tailor it better for you, or cover topics that would be more pressing for you, or of more interest to you. So Julia, with that, I would like to say thank you to all.
Yeah, I see Samuel put his hand up.
Samuel, sorry, Samuel, you have your hand up.
So, thank you. Thank you, facilitators. Can you hear me?
Yes.
Yes.
Okay. Just by way of introduction, I was late to the meeting. My apologies for that. I come from Papua New Guinea. I'm with the Teachers Savings and Loan Society Limited. the organization that I'm in is a financial institution going into banking, and this webinar is really helpful to my organization, especially. We are one of the
That's-
key item for us engaging in for us being granted the banking license was to engage in correspondent banking with international bank, a correspondent bank overseas. So this webinar is very helpful to us. Also, I'd like to mention that it's really timely that we have this training, because we've had a situation here in Papua New Guinea where a bank is about to close the accounts of one of the our fuel service providers, our fuel suppliers in Papua New Guinea, due to issues with their parent company overseas. So it goes back to the correspondent banking due diligence. They found out about some activities of the parent company in other banks in other countries, and they've made a decision to close the account and terminate the relationship with the subsidiary company here in Papua New Guinea. So it just basically, I'd like to say thank you for facilitating this webinar, and I also look forward to the other planned webinar in the coming days. Thank you.
I think there was another person who raised his hand just now. I missed seeing that.
Jonathan?
Yeah, I think, was it Jonathan? Yes. And okay, before we part, I just reposted the link to the Slido, the parking lot, in the chat. Please, you know, I hope it works. It should. Please put your questions in there, something that I can also put into the content for the next sessions. And in any event, if anyone has any other further feedback or questions, I believe you can still reach out to the EDB team, and then also put the questions there as well. So I promise you, this is my my ability to manage the online webinar should improve over time.
Yeah, we should be, well, we understand that you are the expert on the correspondent banking requirements rather than with Zoom. So it should be all good. Yeah, thank you from my end for this good session, Julia, and colleagues. Thank you for your participation. We look forward to your participation in the next webinar, and please pass or share the information about this to your fellow colleagues far and wide. Thank you very much.
Thank you.
Bye.
Have a good day or good evening.
evening.